Good morning, good morning, good morning. It is Friday, the 20th of February. It looks like we made it to the end of the week. This is the Morning Blast with myself, Ryan, and of course, Michael Brown. As usual, this is the Morning Blast. So this is a candid look at markets through the eyes of myself and Michael, obviously. Nothing discussed on the podcast is trading or investment advice. This is recorded live. There's absolutely fuck all editing that goes into this. So you take us as you find us. Trigger warnings and, swear words and et cetera, et cetera. That all kicks on. Welcome to everyone, especially those of you that are listening live. We love you lots, especially those of you that are for some reason up at like 3 a.m. in the morning in the US. Michael, how are you?
Yeah, very good morning to Ryan. Good morning, everyone. Very happy Friday. I'm shocked, to be honest with you. You sound significantly more sprightly than you did about 15 hours ago when you were chewing your way through a pint of Moretti in the cop.
It wasn't going down very well at all.
It really wasn't, was it?
We got to meet young. We got to meet young. Well, the future techs of tomorrow, Clive Lambert's.
We did indeed, yeah. And I don't think we completely scared him off from a career in the city. So,
well, give it time. Give it time.
Well, oh, for fuck's sake!
What?
You fucking cunt! Sorry. You know, I was telling you earlier about Tris Osborne doing a lap on the borrowing data. Torsten Bell is doing the same thing now.
Oh, God. Well, we'll crack on to that in a second, but before we do, let's give an update from Clive Lambert himself at Futures Techs and all of that malarkey. The S&P bounced from a low of 68.47 and 75 cents. So, yes, that was a hold of the 68.45 level that we've been watching of late. The DAX, that was red yesterday, but we were bid so far today. FTSE Futures posted a doji on the same day as making a new all-time high. Bund futures, German government bonds, can't seem to get off the 129.32 level that we've been highlighting of late. And sounds like a stuck record on that one. Forex markets, cable traded back to 134.34. Obviously on the Prince Andrew news, obviously. That's obviously tongue in cheek. Don't think for a second that that's what it was really anything to do with. I'll let Michael allude on that one. Retesting.
No, I'm not going to.
Just for your guide, cable does not move on Prince Andrew news, just for everyone's guide, because some people were questioning that yesterday. This obviously cable is retesting its 200-day moving average. Eurodollar also saw red yesterday with weakness seen to 1.1742. Bitcoin saw green, so bucked the trend regarding the dollar gains. Gold and silver eked out small gains. Things seem to be settled down a little bit there for now. Famous last words. We'll see how that goes. On the London Mercantile Exchange, sorry, I keep saying Mercantile. London Metal Exchange, the LME, copper dipped to 12,670, where buyers stepped in. Nickel held the Marubozu support at 17,140. Aluminium continues to hold its uptrend support. The line on that is now 3,032. In oil space, Brent and WTI, the two benchmarks, they saw further gains yesterday, now printing levels last seen for the front month back in August of last year. In Brent, it's 72.74 to 83. It's the next strong resistance to gun for. TTF, European gas, that gapped up yesterday after Tuesday's engulfing line, but needs to see off 33.29 on a sustained closing basis now to give balls more to cheer. EU carbon markets, that posted a bit of a damp session yesterday, taking pause after recent shenanigans. And finally, from our good friend Clive, wheat had another, obviously US wheat had another strong session yesterday, getting through the 558.6 up to 570. So is now eyeing strong resistance at 573 to 576.4. And we can watch the 560 as support on any dips into today. Michael, what's been occurring?
Very good. Thank you, Ryan. As Dunny's just said, I'm a professional doomster and gloomster, according to Torsten Bell. But there we go. We'll leave it there. What has been happening over the last 24 hours or so? Where should we start? I tell you what, there's been a lot of malarkey going on. So let's get with the UK data first of all, and we can do the geopolitical stuff in a short while.
Yeah.
In terms of the UK data, better than expected this morning. Retail sales rising by 1.8% on a month-on-month basis in January, excluding fuel. Excuse me.
Oh, yeah.
Crikey. Excluding fuel, sales were up by 2% on a month-on-month basis. Clearly, the data's so shocking that I'm choking even trying to get it out. Having said that, the details of the report were, frankly, a bit weird. According to the ONS, growth in retail sales in January of 2026 came largely from strong sales from online jewelers. This is basically retail buying up physical gold as prices continue to rally. Of course, we traded to those $5,600 an ounce record highs in the month of January. And the ONS also said that sales were driven higher largely by artwork and antiques, which is, I reckon, in about 10 years of doing this, a category that I've never seen underpinning a UK retail sales report. And you could argue, just quickly.
Sorry, go on.
I was going to say, you could argue that that's actually a bit of a negative because people only really buy artwork and antiques if they're looking at some sort of store of value over a prolonged period of time.
Well, I was going to say, I've never, aside from underpinning the data, I've never even seen it mentioned at all before.
Well, yeah, there is that as well, actually.
I was a bit taken back when I saw that this morning. I was like, what?
That is a very good point. We also had the latest public borrowing stats this morning, which all the Labour MPs are doing a victory lap about, even though they should not be. Yes, we recorded a £30.4 billion budget surplus in January. And yes, that is the highest monthly surplus since records began in 1993. However, there are a number of caveats that need to come with this data, as is often the case, or as is always the case, actually. We see a surge in tax receipts in January, primarily because it is the self-assessment tax deadline. But also in the January data, if you dig into the figures, we actually saw capital gains tax receipts rising by over 40% year on year, which is basically a sign of people selling investments and selling holdings amid speculation that we are going to see some changes to those capital gains tax rates at some point in the future, which is hardly a particularly brilliant sign for the UK economy. If you also zoom out a little bit, despite that surplus that we recorded in January, year to date, borrowing is still running at its fifth highest level on record. And also the debt GDP ratio is just shy of 93%, which is its highest level since the 1960s. So anyone trying to claim that this morning's public borrowing data means that we're out of the woods, that there's green shoots, that the economy is on a firmer footing, it is, without putting too fine a point on it, complete and utter bullshit. Just utter and absolutely ignore them.
And it should be noted that we actually said yesterday to expect this today.
Yes, we did. And I would hope that none of our listeners have been caught out by the political spin and propaganda that has been put on the data, because, as you rightly say, we did call this out in advance. Anyway, in terms of other bits and bobs from yesterday, we did have some data out of the US. Really strong, actually, initial jobless claims number at 206,000 in the week to the 14th of February, down from 227,000 previously. Actually, the biggest month-on-month decline since November. And of course, that initial claims print does pertain to the February non-farm payrolls survey week. We also had an upside surprise on the Philly Fed manufacturing data. That came in at 16.3, up from the prior 12.6. In terms of other notable headlines on the trade front, the New York Times reporting yesterday that the United States is considering bilateral trade deals with Mexico and Canada, as opposed to a sort of full renewal and renegotiation of the US MCA trade deal. I would note that, actually the New York Times noted this, that the US actually made a similar proposal back in 2018, basically forming a deal with Mexico and then saying to Canada, either get on board with this deal or you're going to be left out. Of course, all of this comes in the broader context of the US MCA renegotiation, which is due to begin in, I think, either June or July. Yeah. Again, as we heard this chatter a week or so ago about Trump, well, it might have been earlier this week actually, about Trump sort of mulling pulling out of the USMCA trade deal. This is all just aimed at gaining negotiating leverage effectively and trying to sort of stake out a position before those talks take place. So that kind of explains.
Escalate to de-escalate.
Indeed. And that very much explains.
Now.
Well, yeah, you've been living under a bloody rock for the last year or so, I think.
Quite.
I mean, I'm not going to quote from the book again, but if you haven't read it, go and read the bloody book. Yeah. It's in the book. You really should know this by now. In terms of other headlines, ECB President Lagarde gave an interview to the Wall Street Journal overnight. She said, and I quote, "My baseline is that I will finish my term at the ECB." Again, that's not really a denial. That's not her saying, "I'm guaranteeing to you right now I'm going to stay here until October of 2027. And as any economist knows, your baseline forecast and your baseline scenario can shift very, very quickly. So that's a story that's going to rumble on for quite some time.
Because you can argue that, of course, the baseline is you finish your term because that's what you're meant to do.
Well, that's literally in your contract.
Yeah, exactly. That is, of course, that's the given. That is the bench. That is the the base case. Absolutely. One interesting thing there was an article yesterday about how her joining or moving to the WEF, the WEF, is no longer a given. And I think you mentioned, and we spoke about this, and we mentioned yesterday that I would love to know what odds it is that she takes over Macron's role.
Oh, God.
As leader of the party. Not necessarily. I'm not suggesting that automatically she gets voted in at the next election, because obviously Le Pen, etc. But yeah, it seems that timing and all this seems to be coming all together at the same time, where potentially it would be like an easy fit for her to move in and replace Macron, and it would fit because how the stars are aligning, etc.
Yes, no, absolutely. So, yeah, that is worth keeping an eye on. Reuters also had a sources piece around this yesterday, noting that apparently ECB President Lagarde had told her colleagues that if she was planning to step down, she would tell them first. Apparently, the colleagues who were involved in these conversations interpreted those remarks to mean, and I quote here, that a departure is not imminent but could occur. Again, if you weren't even thinking about leaving, you'd just come out and shut this story down because it would be really easy to shut down. So I think that's very much a case of there being sort of no smoke without fire. Just a couple of other headlines from me before we move on to a bit of a geopolitical conversation. We heard from BOE's Catherine Mann yesterday. Is she finally making the long-awaited dovish pivot? It sounds like she might be. She was saying that January's inflation data was good numbers and that she also views it as concerning to have seen unemployment rise to the degree that it has. Of course, Catherine Mann has been one of, if not the most hawkish members on the Monetary Policy Committee for quite some time now. We've already got 4 in the dovish camp per the February MPC, very much expecting Governor Bailey to make it a 5th and make a majority in favour of a cut at the March meeting, but maybe Mann is going to flip to the dovish side as well. And last but by no means least for the time being, Nvidia. There were reports, according to the FT this morning, that their $100 billion deal to invest in OpenAI is now a $30 billion deal to invest in OpenAI, which is still a fairly significant chunk of cash, but not quite as significant a chunk of cash as it was going to be when this first came out.
Exactly that. Thank you for that, Michael. So today, what are we going to be having a quick natter about? Well, it's geopolitical risk, really. And as Michael said just now, and kind of how to trade, what to do. Well, can't exactly tell you how to trade it. Well, no trading advice, etc. But it is something we do need to think about as traders, especially on a Friday, especially given in times like this where there's a lot of headline risks. So obviously, it's the classic geopolitical weekend risk problem today. Like, do you hold positions into the weekend where a US-Iran conflict could begin? Do you hedge? Do you flatten? Difficulty being that geopolitical risk is almost always overstated in markets, especially on social media. History says most threats don't materialize, but when they do, the moves can be pretty enormous and one directional. One thing to kind of watch specifically maybe is, I would say, what for me, I always like to, if I can, be flat over the weekend, especially at the times like this. Do you use options for tail risk protection? What is the option market telling us? Look at gold. Michael, I don't know about you, but I always kind of like to see how, towards the back end of the session on a Friday to see how people position themselves going into the weekend. But, obviously it's a bit asymmetric in oil, for instance. Look,
Yeah.
if we come away from the weekend, over the weekend and nothing's happened, you could, I think you could very easily see crude off a couple of dollars on Monday. But at the same time, if something did happen, obviously we're going to get a spike higher. What are your thoughts?
Yeah, no, I think you're absolutely right. And, we just to sort of set a bit of broader context around things, we have seen Brent and WTI continue to rally over the last day or so, both benchmarks trading as near as makes no difference 6-month highs this morning. One of the other interesting things that we've seen, and I don't think this is, I'm by no means a crude expert, so if I'm noticing it, then it must be pretty damn obvious. But we've also seen a bit of a widening in the premium of Brent over WTI. And the reason why that's important is because obviously Brent is the quote unquote global benchmark.
Yep.
WTI is very US centric, and that is a representation of the geopolitical risks that the market is discounting. We did have some comments from President Trump yesterday. Again, it's all very conflicting. On the one hand, Trump was saying talks with Iran are good. On the other hand, he was saying that if there's no deal, then really bad things will happen. He was then saying we'll find out maybe over 10 days, maybe over 15 days as to when, or indeed if, there will be peace in the Middle East. All of the sources reports that we've got indicate that Trump is continuing to be presented with options in terms of a potential military strike, whether that is a limited option to try and sort of force Iran into doing some sort of a deal, or whether that is a more wide-ranging operation aimed at something much more significant, such as regime change. We do not know. But I think from a market's perspective, I would be very much leaning towards your perspective, which worries me greatly, in that actually there is next to no disadvantage or downside in just being flat into the weekend. And none of this is trading advice, of course, but let's say, you close out a WTI long at $66.50 a barrel this afternoon. Nothing happens over the weekend. If you still have that view that you want to be long for whatever reason, just get back into it on Monday morning, because I think that is just going to be the most prudent strategy from a risk management perspective, and not, you then don't even need to worry or even consider about the potential gapping risk. And I think it's interesting you mentioned or sort of alluded to the potential that gapping risk is two-way, because I think it is. We often sit here and go, actually, we're all just worried about a gap higher if war does break out, and that's a rational concern. But if it doesn't, you think about this time 2 days ago, WTI was trading at 62. We're now trading at 67. How much of that would be unwound if we go through a weekend where all is relatively calm and nothing changes?
Well, no, exactly that. It's very easy to sit there and go, "I'll just be long, over the weekend, try and predict something all booting off." But I can promise you, most weekends, nothing happens. And it may, you may look at it on, God forbid something does kick off over the weekend and oil does gap up, $10 or whatever over the weekend. To be honest, it'd probably be a sell if it did do that on Monday. But more often than not, that doesn't happen, and you're just giving back every weekend for people that do that. Of course, when you look at it, you say, "Oh, yeah, I caught a $5 move, or I caught a $7 move, or whatever." Oh, this game's easy. But the other 4, 5, 10 weekends that you've tried doing that and tried predicting, you've lost $2 every time, or you lost $1 every time. So it does eat into that when you kind of put it all together at the end of the year and clock and like count it all up. So for me, days like this have always been about risk management rather than prediction. Because it might not be as sexy, but unfortunately, sometimes trading isn't sexy. Trading's about making money at the end of the day. In terms of like practical framework to identify exposures, obviously, make sure you are sizing appropriately for a weekend where distribution outcomes are wider than normal, and make sure you have a plan. Basically, what is your plan come Monday if nothing has happened? What is your plan come Monday or the Globex opens Sunday night if something has happened? And again, we talk about this a lot. It's like capital preservation is, most of trading is just capital preservation, basically. The longer you're in the game, the more chance you've got of winning. So I think it's something just to kind of be mindful of. It'd be great if we could all like hit home runs every time. That's not how trading works.
No, absolutely. And I think it is going to be interesting to see how mainly crude and also precious metals such as gold trade into the weekend. Once we've got through some of the data that we've got coming out this afternoon, and we do see, are we seeing some inflows into gold? Are we seeing some positions get squared up? I think that is going to be quite telling just in terms of trying to gauge how participants are positioned as we move into the weekend, which in turn, as you mentioned, can kind of help shape and frame those expectations as to how the market may react when things get back up and running on Sunday and on Monday morning.
Exactly that. Well, speaking of, the weekend, what have we got to look forward to for the rest of the day?
Yes, indeed. Well, I can tell you one thing. There's going to be a hell of a lot of headlines on the geopolitical front. So do keep a very, very close eye on that. And I think there's going to be a lot more noise than there is signal. As for scheduled events, though, we start off with a whole host of PMI figures. We get data from the Eurozone in about 8 minutes' time at the top of the hour. The composite PMI is seen rising to 51.5 in February, up from the 51.3 that we printed in January. And then at 9:30 this morning, we get the latest flash PMI data from here in the UK, where the composite PMI, that's seen falling slightly to 53.2, down from the prior 53.7. Actually, in terms of those January metrics here in the UK, I think there was almost a mechanical rebound in a lot of the data, basically, as we moved through that post-budget uncertainty. It wasn't everyone going, everything's great here in the UK. It was more a case of at least we got some certainty over the government's policies, and that saw a bit of a mechanical rebound in sentiment, and that's going to start to fall out of the data as we move through the remainder of the quarter. In terms of other bits and bobs to keep an eye on today into the afternoon, we've got a few data points out of the United States. We got our first read on fourth quarter GDP at 1:30 London time. The economy is set to have grown by 3% on an annualized quarter-on-quarter basis in the last 3 months of the year. That would be a fair chunk slower than the 4.4% pace that we saw in Q3. But remember that the US government was shut down for 7 weeks in the fourth quarter, and that is basically entirely responsible for the skew lower that we see quarter on quarter. And also bear in mind that in the Q1 GDP release, when we get that in due course, that's going to be skewed higher because the government reopened again. So a lot of mechanical noise in the figures. Also at 1:30, we get December's core PCE figures. Of course, this is the Fed's preferred inflation metric. Core PCE seen at 2.9% in December, up for a prior 2.8%. There is quite a wide divergence at this point between CPI and PCE. There's a number of technical measurement reasons for that, which I really can't be bothered to go into on a Friday morning, but do just bear that one in mind if you're trying to compare the two. And also at 1:30, we get December's retail sales numbers from Canada. Sales seen having fallen by 0.5% on the month over the festive period, compared to the 1.3% rise that we saw in November. Moving on from that, at 3:00, we get final consumer sentiment numbers from the University of Michigan. And also this afternoon, we're due to hear from the Fed's Bostic. This fella is just trying to get in as many speeches as he can before he retires next Friday. It's bordering on farcical at this point. And we also hear from 2026 Fed voter Logan this afternoon as well. And the other thing to keep in mind as we move into the afternoon is that the Supreme Court in the United States are due to issue opinions at 3:00 this afternoon London time, 10:00 this morning on the East Coast. Again, they might rule on the IEEPA tariff case, but as always, they will not be pre-announcing the cases that are going to be ruled on. This is the fourth opinion day I think they've had where they could rule on these tariffs. They have also got opinion days next Tuesday and Wednesday. Again, it's very much a case of wait and see. Around 3:00 this afternoon, we may get an opinion, we may not. We simply just have to wait and see what the Supreme Court give us. But regardless, there are, of course, various other sections of commerce law that the administration can use to basically re-implement very similar tariffs and keep the overall average tariff rate effectively unchanged. So in the longer run, it shouldn't be a massive issue. And last but by no means least, just going back to the discussion we did just have, of course, do bear in mind the potential for gapping risk in both directions over the weekend, given those tensions in the Middle East continuing to run very, very high indeed. But for this morning and for this week, that is all from me.
Michael, thank you very much, my Dear friend, you're an absolute star. Thank you for the beer yesterday as well. Didn't go unnoticed that you bought me a beer, and Clive did as well. Well, actually, Clive Jr. bought me a beer
With his dad's card.
with his dad's card. So I'll take it.
That's a great way to do it. I might try that trick.
Well, exactly. I wish he would give me his card. But listeners, thank you so much for another great week. And we really, really do appreciate you, especially those of you that take the time to listen in live. Not that it makes any difference because, again, there's no editing at all to go through. Whatever you're doing this weekend, have a good one. Much love. Call your mum, call your dad, go out, meet a couple of mates, have a good one. But